Welcome to the deep dive. Today we're plunging right into the energy sector. It's always moving, isn't it? A real interplay of markets, new tech, and those big sustainability pushes.
Definitely. Never a dull moment.
Right. So our mission today is to unpack how companies in this, well, vital sector aren't just getting by, they're actually figuring out how to thrive, often by bringing in specialized expertise, specific solutions.
Exactly.
We're basing this deep dive on a couple of key sources. We've got a good overview of oil and gas trends from around mid-2025, and also some really interesting insights into a company called EAG Inc. They do expert consulting and outsourcing solutions right in the thick of it.
That's right. And what we want to do is really reveal those critical challenges, the strategic shifts happening right now. And you'll see how these external partners are becoming just crucial for navigating all this complexity.
Like digital transformation.
Yeah, digital transformation, workforce changes, all of it.
Okay, let's unpack this then. Our sources are calling the upstream oil and gas sector here in Q3 2025 as being at a, quote, pivotal inflection point.
That sounds about right.
Yeah, we're talking about these big overarching challenges like oil price volatility just won't quit.
Nope. Still a factor.
Plus, finding that high-quality domestic acreage, getting tougher.
Yeah.
And then there's always the shifting geopolitical currents.
And what's really fascinating here is seeing how these aren't just minor issues. They're actively forcing producers to rethink, well, almost everything.
How they spend capital.
How they spend capital, how they bring in new technology, their entire sustainability game plan. It's a fundamental reevaluation.
And you can really see that playing out in the M&A market, right? The deal-making side.
Oh, absolutely.
Our sources, looking at inverse data via Reuters, point to this massive slowdown in U.S. upstream M&A. It dropped, 80% year over year in Q2, down to just $13.5 billion. That's huge.
It's a staggering drop. And the reasons, well, they're pretty clear. Those oil prices bouncing around, sometimes below break, if you mentioned, around $66 a barrel.
Makes buyers nervous.
Extremely nervous.
Yeah.
Plus, like you said, that prime U.S. shale inventory, it's shrinking.
So operators are looking elsewhere now.
They have to. They're casting a wider net, looking at international basins. Think Vaca Muerta down in Argentina, big shale play there, or even offshore Canada.
Okay, so this M&A shift, it really speaks to that need for adaptability, doesn't it? Facing all this uncertainty.
It really underscores it. It shows companies can't just, stick to the old playbook. This slowdown means the focus is shifting, less about grabbing land through deals.
And more about what? Optimizing what they have.
Exactly. Optimizing current assets, exploring new avenues, maybe less conventional ones. It's all about smarter, more disciplined strategic thinking.
Okay, but here's where it gets really interesting, kind of counterintuitive. Despite that M&A slump, U.S. rig counts actually went up in mid-July. First time in 12 weeks. How did that work?
Yeah, that's a key observation. It seems to be largely driven by natural gas.
Okay.
There's this renewed interest specifically in places like the Haynesville, Louisiana, Texas, and the Utica Shale up in Ohio. And it's mostly down to persistent LNG demand.
LNG, liquefied natural gas, for shipping it overseas.
Precisely. So producers are kind of rotating their portfolios, getting more gas heavy. They're anticipating better seasonal prices and definitely that continued growth in LNG exports.
And the service companies are following suit.
They are. Big players like Halliburton, SLB, they're actually pivoting their tech investments to specifically back these gas-focused operations. Tells you how significant this shift feels internally.
That's fascinating. So gas is rebounding, but we're also hearing about enhanced oil recovery, EOR making a comeback in older fields. Why now?
Good question. It's gaining traction mainly because that top-tier, Tier 1 shale inventory is getting harder to find. So operators are thinking, okay, how do we squeeze more oil out of the assets we already have, legacy assets?
Makes sense. What kind of tech are we talking about?
We're seeing things like co-generous injection, pumping carbon dioxide downhole to make the oil flow easier, polymer flooding, using chemicals to thicken the water push.
Right.
And surfactant EOR, basically using detergents. Seeing that particularly in the Permian and Eagle Ford.
And the payoff.
It can be significant. Improving recovery rates by maybe 10, even 20%. Plus, if you pair it with co-ure sequestration capturing that QRO.
It helps with the carbon goals, too.
Exactly. It aligns really well with those lower carbon objectives.
And thinking more globally, you mentioned international exploration earlier. Our sources also talk about a quiet rebound in offshore exploration.
Yeah, it's definitely happening. Maybe not with huge fanfare, but it's there. Discoveries leading the way are in Latin America, think the Guyana Suriname Basin, Brazil's pre-salt fields,
Right, we've heard a lot about those.
and also West Africa, particularly Namibia's Orange Basin.
What makes offshore viable again? Didn't it used to be super expensive?
The economics have shifted quite dramatically, actually. Break-even costs are way down, maybe $35 to $45 a barrel now in many cases.
Wow.
Plus, you've got better tech. Advances in subsea tiebacks connecting new wells to old pipes, basically. And more efficient FPSOs.
Those floating production facilities.
Yep. The floating production, storage, and offloading vessels, they make developing deepwater fields much more feasible.
So taking these EOR efforts and the offshore stuff together, what role do they play strategically?
I think they represent a really important diversification. They're a long cycle investment, right? It takes time. That acts as a kind of counterweight to the quicker ups and downs of shale production.
Balancing the portfolio.
Exactly. Balances the portfolio, hedges against different market swings, and helps ensure resource supply over the longer term.
Okay, let's shift gears a bit, move from the fields to inside the companies themselves. There's this internal transformation happening too. One major issue our sources flag is a pretty serious talent shortage upstream.
Oh, it's a big one.
Yeah, the stat is stark.
Yeah.
Nearly half the workforce is over 50, and fewer young folks are coming in. So what are companies doing? How do you tackle that kind of brain drain?
It's a critical challenge, no doubt. And companies are really pushing hard on digital upskilling.
Like training.
Yeah, using tools like augmented reality, virtual reality for more immersive training, getting people comfortable with AI, promoting AI literacy, using remote monitoring tools, which also enables more hybrid roles.
Right, virtual field operations.
Becoming much more common. It opens up the talent pool, lets people contribute from different locations.
But that raises a tricky question, doesn't it? How do you hold on to all that valuable knowledge from the experienced people?
The institutional memory.
Yeah, while also bringing in and integrating the tech-savvy talent you absolutely need for the future.
It's a very delicate balancing act. I think the key is having solid knowledge transfer programs. Mentorship is huge, but also embedding that knowledge into digital systems.
Making it accessible.
Making it accessible, yeah. So new hires can tap into it. It's about blending that hard-won experience with the power of new tech.
And speaking of tech, digital innovation, AI adoption. It seems like it's really accelerating.
It has to.
Our sources are pretty blunt. Digital transformation is, quote, no longer optional. Margins are just too tight.
That's the bottom line.
So what are the key digital trends you're seeing making a difference?
Well, we're seeing some major shifts, things like large language models, think ChatGPT, but trained specifically on geological and subsurface data.
Specialized AI.
Right. Using it for complex data analysis, helping make better decisions faster. Edge computing is big, processing data right there at the well site or platform. Cloud platforms, obviously.
And software tools.
Lots of software as a service.
Yeah.
Companies like SLB, Baker Hughes, they're offering cloud-based tools for things like automating drilling and production.
And does it actually save money?
The data suggests it does. Insights from firms like EY and Deloitte point to potential cost reductions of like 15 to 20% in field ops and maintenance thanks to these digital tools. That's significant.
Definitely significant. Okay, so efficiency is key, but what about sustainability? Is that gaining real traction beyond just, talking points?
I think it is, yeah. We're seeing actual measurable progress. For instance, methane emissions in the Permian, down almost 50% since 2012.
Wow.
A lot of it is better monitoring, using satellites like Methaneset to pinpoint leaks. And flaring intensity burning off excess gas that fell in the U.S. by about 5% in 2024, mainly due to better midstream infrastructure to capture that gas.
So infrastructure upgrades help.
Big time. And then you have these large-scale projects like Canada's Pathways Alliance, really pushing carbon capture and storage CCUS. They have ambitious goals to decarbonize upstream ops by 2030.
So this isn't just PR anymore. What's driving it?
Well, part of it is certainly increased regulatory pressure, but also investors are demanding more ESG accountability.
Environmental, social governance.
Exactly. So these sustainability efforts are moving from the communications department to become real performance metrics. They're actually influencing investment and strategy now.
Okay, so we've laid out the challenges. The M&A slowdown, the talent gap, the push for digital efficiency, the sustainability demands. The big question is, how do companies actually do all this?
Right. It's one thing to talk about it.
Exactly. And this seems to be where specialized partners like EAG Inc., that we mentioned earlier, really come into play. What makes a company like EAG fit this picture?
EAG is a really good example of this strategic partnership model we're seeing. They've got, what, over 20 years in the game?
Yeah, that's what our source says.
And they work across the board, mining, upstream, midstream, even renewables now. So take their consulting services, for example. They don't just give advice, they actually help implement things like process automation.
Cutting down reporting times, that sort of thing.
Yes, significantly,
So-
turning raw data into something useful. Or look at their IT outsourcing, helping companies modernize old systems, which, going back to the talent issue, helps attract those tech-savvy people you need. They also do back-office outsourcing and offer specific software-as-a-service solutions.
It sounds pretty comprehensive. And their track record seems solid.
It does. The source mentions deep industry expertise. They do over 100 engagements a year and apparently have an 80% client rehire rate, which is pretty impressive.
That says a lot, yeah. And their CEO, Elizabeth Gerbil, was featured on that Pavilion AI podcast, apparently. Plus, seeing them show up at major industry events this year, Enverus, EVL, MII, NAPAC, IFS Connect.
It shows they're plugged into exactly these issues we've been discussing: SaaS, analytics, automation, AI.
Right, it really ties it all together.
So, when you boil it all down, success in the energy sector for the rest of 2025 and beyond really seems to hinge on, well, a few key things. Adaptability, definitely.
Yeah.
Disciplined innovation. And strategically using these digital tools and, crucially, these expert partnerships.
Absolutely. Staying informed, understanding these dynamics. That's really the first step for anyone navigating these shifting sands, whether you're trying to optimize a portfolio, get smarter field intelligence, or push towards those net zero goals. Couldn't agree more. So maybe a final thought for you, our listener. What else might get completely revolutionized when these huge legacy industries fully lean into cutting-edge tech and these kinds of external partnerships to solve their biggest problems? Makes you wonder, right? How similar models could transform other sectors that are also facing such rapid fundamental change. Something to think about.